Good morning and welcome to TOITOI Japan Market Radio, coming to you from Tokyo on January 22, 2026. I'm your host, and we're here to help global investors navigate the Japanese market landscape with data-driven insights and professional analysis. Today we're seeing some interesting moves across equities, currency, and rates, so let's dive straight in. Joining me as always is our portfolio manager who focuses on Japanese macro. What's your take on today's session?
Thanks for having me. We're looking at a fairly constructive day for Japanese equities, though there's some divergence beneath the surface. The Nikkei 225 closed at 53,688.891, up 1.732%, showing solid momentum in the large-cap export names. TOPIX came in at 3801.0, gaining 0.849%. So a bit more muted but still positive. The Mothers Index, which tracks growth and emerging stocks, added 0.536% to close at 2249.0. The one laggard was J-Right, down 0.074% to 2027.0, reflecting some modest pressure in the real estate space. On the currency side, dollar-yen is trading at 158.787, up 0.395%. So we're still hovering in that elevated range. Commodities showed weakness, with gold in yen terms down 0.734% to 18,255.0, and crude oil fell 1.765% to 59.55.
That equity performance is notable, especially the gap between the Nikkei and TOPIX. Before we unpack the drivers, let's turn to some of the key stories moving markets today. We're seeing headlines around dollar weakness tied to easing geopolitical tensions, specifically around U.S. concerns over Greenland. Can you walk us through what's happening there and why it matters for Japan?
Absolutely. The U.S. dollar has been weakening as concerns regarding potential U.S. acquisition of Greenland have eased, allowing market focus to shift back to economic fundamentals and incoming data. Essentially, we had a geopolitical risk premium built into the dollar, and as those tensions subside, that premium is unwinding. For Japan, this has several important implications. First, a weaker dollar typically supports yen appreciation, which is structurally a headwind for Japanese exporters but beneficial for import-heavy sectors and can support real asset valuations. Second, dollar weakness may reduce imported inflation pressures, which could affect the Bank of Japan's interest rate trajectory and inflation outlook going forward. Third, easing geopolitical tensions generally support risk-on sentiment, and Japanese equities tend to benefit as a cyclical play on global growth recovery.
So we're looking at a bit of a mixed picture for Japanese assets depending on the sector. How are you thinking about the impact on equities specifically, given that yen strength can be a double-edged sword?
Exactly right. For the Nikkei and TOPIX, the environment is potentially positive because the risk-on backdrop from de-escalation supports equity valuations broadly. However, yen strength may cap gains in exporter-heavy names, so we could see some rotation within the market. On the currency side, dollar weakness puts downward pressure on dollar-yen, so we need to monitor technical support levels closely to see if this move has legs. For JGB yields, there's a modest upward bias. If risk appetite improves and that geopolitical premium continues to unwind, longer-dated JGB yields may face some selling pressure as investors move out of safe havens. The key monitoring point here is whether dollar weakness persists or reverses on incoming U.S. economic data, because that will determine the sustainability of yen strength and its impact on export-oriented earnings forecasts.
Staying with the currency theme, Reuters is reporting that the dollar edged lower as Greenland concerns ease and data comes back into focus. Does that align with what you're seeing in the flows?
It does. The market had been pricing in a degree of uncertainty around U.S. geopolitical posturing, and as that fades, we're returning to a more data-dependent environment. For Japan, that's important because it means currency moves will be driven more by relative growth and monetary policy differentials rather than external shocks. If the BOJ continues its gradual normalization path while the Fed holds steadier cuts, that could provide some structural support for the yen. But if U.S. data comes in stronger than expected, we could see the dollar rebound and push dollar-yen back higher. So it's very much a two-way risk from here.
On the policy side, we're also seeing some significant domestic headlines. Nikkei Asia is reporting that Japan's budget surplus plan faces further delay as Finance Minister Shunichi Takaichi pushes for increased government spending. This sounds like another setback to the fiscal consolidation timeline. What's your read on this?
This is a critical development for Japan's fiscal sustainability. What's happened is that Minister Takaichi is advocating for increased government spending, which will postpone Japan's plan to achieve a primary budget surplus yet again. This is another in a series of delays to the fiscal consolidation timeline that has been repeatedly pushed back over recent years. Why it matters is straightforward. Japan already has one of the highest debt-to-GDP ratios in the developed world, so delays in achieving budget surplus undermine the credibility of fiscal reform efforts and raise serious questions about long-term debt management. Takaichi's spending push is likely driven by economic stimulus priorities or social spending needs, but it signals that near-term fiscal consolidation remains subordinated to growth and spending objectives. This complicates the Bank of Japan's monetary policy normalization path and strains confidence in Japan's medium-term fiscal trajectory.
So how should global investors be thinking about the market impact here? Does this change the outlook for equities or bonds?
In the near term, it's likely positive for equities because stimulus expectations can support growth and earnings. However, longer term, it could weigh on sentiment if markets start to reprice fiscal sustainability risks. We might see defensive sectors outperform cyclicals as investors get more cautious. For the yen, this is a potential headwind. Persistent fiscal deficits and a spending bias reduce the appeal of holding yen, particularly if the BOJ remains accommodative. That could support dollar-yen and other yen crosses. On JGB yields, we're looking at upward pressure on the long end if markets demand a higher risk premium for extended fiscal deficits. 10-year JGB yields could rise as investors reassess sustainability concerns, though BOJ yield curve control remains a constraint for now. So it's a delicate balance between near-term stimulus optimism and longer-term fiscal credibility.
That makes sense. Shifting back to equities and corporate news, we're also seeing a notable story out of the energy sector. Bloomberg is reporting that TEPCO has paused a nuclear reactor reboot just one day after achieving a milestone restart. This seems like a significant operational setback. Can you explain what's going on and why it matters?
Certainly. Tokyo Electric Power, or TEPCO, halted the restart of a nuclear reactor just one day after achieving what was considered a significant milestone in bringing that reactor back online. The utility paused operations following what appears to be an unplanned shutdown or a safety-related issue, so this reverses momentum on a key energy infrastructure initiative. For Japan, this is material on several fronts. First, energy security. Japan has been gradually restarting idle nuclear capacity post-Fukushima to reduce reliance on volatile fossil fuel imports and manage power supply stability. Second, inflation and costs. Nuclear restarts are critical to controlling long-term electricity costs and energy inflation, which directly impacts corporate profitability and household spending. Third, policy credibility. This pause raises questions about regulatory confidence and the feasibility of Japan's nuclear restart roadmap, which is essential for meeting climate targets and baseload generation needs. And specifically for TEPCO, as Japan's largest utility and a major employer, operational setbacks can undermine investor confidence in the utility sector recovery.
So what does this mean for the broader market, especially for investors holding Japanese equities or watching the yen?
For equities, this is a slight near-term headwind for TEPCO shares in the utility sector. There could be broader negative sentiment if restart delays appear structural rather than just a technical hiccup. Energy-intensive industrials like chemicals, steel, and semiconductors could face margin concerns if nuclear delays imply higher power costs going forward. On the yen, we could see modest weakness if restart setbacks suggest prolonged energy import dependency, which would widen the current account deficit and dampen real yield attractiveness. For JGB yields, there's potential for slight upward pressure if nuclear delays entrench inflation expectations and energy cost pressures, though the effect would be minor given the current yield environment. The key monitoring point is TEPCO's root cause disclosure and the regulatory response. A brief technical pause is much less concerning than evidence of systemic safety or operational issues that could delay the broader restart agenda across Japan.
That's a really important distinction. So we're watching for clarity from TEPCO and the regulator to gauge whether this is an isolated incident or something more systemic.
Exactly. If this is just a procedural pause or a minor technical adjustment, the market will likely look through it. But if it signals deeper challenges with the restart process, that could have longer-term implications for Japan's energy transition and cost structure.
Let's bring it all together for our listeners. We've covered dollar weakness tied to easing geopolitical tensions, fiscal policy delays, and a nuclear restart pause. What are the main themes global investors should be focused on as they monitor their Japan exposure?